Good afternoon. It's 3 p.m. here in Copenhagen, Denmark. Let's kick off the today's webinar. My name is Arne Lohmann Rasmussen. I'm head of research here at Global Risk Management, or GRM. I'll be a host for today, and with me I have my colleague from sales, Daniel Wiksel. And the program for today is relatively simple. We will aim for like 45 minutes in total, including a question. But I will talk a bit about what is driving the price for carbon emission, or EUAs. And Daniel will dig deeper into risk policies, hedging strategies, how to actually deal with this in the daily operations, and what strategies to utilize. But without further ado, I think we will kick off the webinar. You're welcome to ask questions during the webinar. There's a Q&A button on the top, and there you can, if you push that, you can ask questions. You can also post them anonymously if you don't want your name to be shown to the audience. We'll take the questions after the two presentations, but feel free. If we talk about the EU ETS, European Emission Trading Scheme, and the so-called EUAs, EU allowances, it is what we call a cap and trade system. There's a cap on the amount of allowances in the market, and they can be traded. Thereof the cap and trade definition. What is covered in the EU ETS? It is the EU countries plus Liechtenstein and Norway, the so-called EEA or EFTA states. It's roughly 10,000 installations in the energy sector and manufacturing. Then we have airlines are included for some years. Shipping came in 2024 with 40%, 70% this year, and 100% next year. The target for the EU ETS is to reduce emission by 55% by 2030, the so-called Fit for 55 in the US. Do notice that's actually higher demands for the installations or the industries covered by the ETS. That is 62%. The reason is that some sectors are not included in the scheme and have no targets, like farming, for example, agriculture. How do we do this? Key to understand is that we have this linear reduction factor every year. The number of the cap is lowered by 4.4%. So either be auctioned, sold less EUAs, or there will be handed out less free allowances, but it is linear reduced every year. So there will be less and less EUAs in the market as we move forward. If we look at the EUA price, which you have on your screen here, we had a relatively stable price in the beginning, or 6-7 years ago, around 20 euros per metric ton. Then we moved higher in 2020, up to almost 100 euros per metric ton. We stayed there with some volatility. The war came in Ukraine, gas prices spiked, but then prices actually started to move lower in 2023, going into 2024. I think the big driver back then, and of course something to be very focused on also this year and next year, is that we actually had a lot of renewables in the system. And why is that important? Because the power sector is roughly 50% of the emission, and especially the power sector switched significantly to renewables in 2023. Wind, solar, nuclear power, hydro. We had the war in 2022, but we also actually had a renewables crisis, less renewables in the system. That really changed that year. and in a way the market will probably overhedged going into 2024. Then prices started to recover again, gas prices moved up, and we are now trading around the 70 level. This year we have a high correlation with risk appetite. I will show that later, and also gas price. I'll come back to that. But there are some major shifts in the market, but I think we are facing a more stable market now than we were used to 2 or 3 years ago. What you see on your screen here to the left is the EUA daily future, the dark one over here, trading just above 70 euros per metric ton, and then we have the front month TTF gas future over here, and as you can see, relatively high correlation. That said, we have seen a tendency recently that EUAs have run ahead of the gas price. The gas price has been more or less stable since we had the Trump in the Rose Garden and equities dropped significantly. EUA prices have recovered. Gas prices are much more stable. It's a bit of you can actually call that a bit of a surprise, given that there's not much fossil fuel during the summer, because in the power sector you have more renewables, so you don't need to buy EUAs, whereas there has been a demand for gas to refill inventories. What we have seen is that EUAs have been very correlated with what I would call risk appetite or global equity markets. What I put out here on the right-hand side is the German DAX index and the EUA price, and as you can see, they have been following each other quite closely. It seems like the market is basically trading on the narrative that when equities goes up, especially in Germany, it is a reflection that the German industrial sector, manufacturing sector, is doing better. When that is doing better, they need more power, they need more fossil fuel, they need more natural gas, and hence they need more emission allowances. Is that going to continue? That is hard to say, but I think it is a reflection that there is actually some optimism now around the German economy, and Germany is, of course, very important for the EUA market. It is the biggest emitter. It is in Germany where we have the very heavy energy consuming companies. So what happens in Germany is, of course, decisive here. But we should be a bit careful here. The German DAX is, of course, also a reflection of how the global economy is doing. German companies are global companies. The EUA is a EU system. It is only dependent on the supply and demand in the European Union, and including those two countries I mentioned before. But noteworthy that we have this close correlation with risk appetite. I think it also reflects that there's not that many drivers in the EUA market, so the day-to-day trading is very much focused on risk appetite, focused on gas and so on. Why is the gas price important? Why is that? It is basically because we have the so-called fuel switching in the power sector. When gas prices are high, there's a tendency for power producers, especially in Germany, to switch towards coal instead of using gas, because that is cheaper. But when you use coal, you will need to purchase more allowances because it's more emission heavy. Vice versa, if the gas price goes down, like here, you will have a tendency to switch to natural gas, because that becomes relatively more cheap, and you need to purchase less EUAs. At the moment, since January, coal prices have underperformed gas prices, so there is overall a tendency for power producers to switch to coal instead of gas. That could also be a reason why we have seen this outperformance of EUAs relative to gas prices. There's actually also been less, especially wind in the system for the last 4 months. It's pretty windy here in Copenhagen today, but that's actually something new. If we have less renewables in the grid, in the system, it means more demand for EUAs, because then you need to produce power from either natural gas or coal, which are of course emission intensive. So this fuel switching is a key factor to watch. There is of course less fuel switching at the moment because there's much more renewables in the system. Especially solar power will be dominating the next 3 or 4 months, especially during daytime, of course. But if there's no wind in the night and there's not enough nuclear power, you will switch to fossil fuel, creating a demand for EUAs. Price developments, we talked about that. That was the spot price. There's of course also a forward market, quite a well-functioning forward market in the EUA market. What you see here is the forward curve 5-6 years ago, very, very flat. That reflected that back then interest rates were 0 or even negative. Today, we have the spot here, and then we have an upward sloping forward curve. The curve is in contango. It reflects that the interest rate is now positive. The forward curve, the structure of the forward curve is a reflection of the interest rate curve. In that respect, the EUA forward curve is very different from the forward curve you find, for example, in natural gas, in oil, in other physical commodities. You can have a price today that can be very high because if there's no specific commodity, the price will go up, even though everyone knows that in half a year there will be plenty of products in the market. The EUA market doesn't work like that. That is a financial market, and if it didn't, and if the curve didn't reflect the interest rate, you will have sort of arbitrage in the market. I sometimes sort of say that the EUA is like a bond without a coupon, without a yield. So just to convince you that this is actually the truth, this is the percentage difference between the December 26 contract and the December 25 contract in percentage point, and then it's a two-year swap rate, the dark one, and you can see they are, when interest rates goes down, as we have seen here, the curve will tend to flatten, being less in contango. It also means that as interest rates have been slashed by the ECB from 4% to 2%, that the forward curve is now less steep, less in contango. It is, you can say, cheaper to buy EUAs forward because the curve is less in contango. It of course also reflects that the funding buying EUA spot are also lower for most companies, but it's important to understand this connection with the interest rate curve that is deciding the forward curve. So the forward curve has nothing to say about future demand and supply expectations in the market. You can always argue, is that the case, for example, in oil? It is probably to a certain degree. That thinking does not apply to the EUA curve. But it is reflected, expectations are reflected in the spot price. I'll come back to that. What you see on your screen is some calculation I've done based on, for example, various sources. So it is supply and demand. That was more or less in equilibrium, in balance. This year will be in balance this year, also last year, the year before. But if we look forward to 2026, 2027, most analysts argue, me included, that there will actually be a deficit. There will be more demand than supply in the market. There are various reasons for this. One reason is that in those years, you actually borrowed some EUAs from the future, the so-called Repower EU. That was a program set up in the beginning of the war in Ukraine, and the high gas prices to support the European economy. Part of that funding actually came from front loading. You basically sold some of the EUAs supposed to be sold here. You sold them earlier. So that helped support the market. Last year kept prices low, but it will come back and haunt the market because they will not be able to sell them again They have already been sold in the market. Then there are some technicalities around how shipping was introduced. Some extra allowances were added to the market in 2024, but maritime sector was only had to hand over allowances for 40% of the emissions, 70% this year. That will be 100% next year. The market also have to absorb that there will be no more free allowances in the airline sector. What is going to happen to prices? Of course, short term, you should expect to be volatile, trading on risk appetite, trading on gas prices. Will there be a trade deal with China or not, and so on? Not very different from other markets. But if we take on sort of a bit medium to long term view, one thing we can do is to use what are analysts saying about prices next year, the year after, and so on. And what they're saying is that if we look 3 years ahead, the average analyst would expect EUA prices to be above 100, and the mid 90s in 2027, and the mid 80s in 2026, and actually also rise slightly for the rest of this year. I guess most analysts here to the right, they have this view in their head that there will be a tight market balance next year. So they're saying prices will go up. If everyone in the market believe that, the price should actually go up today, because otherwise there will be arbitrage buying today and sell them forward. Of course, nobody knows the future by certainty, but I think there is an argument that during this year it is time to look ahead. The market will start to price in this tighter market the next 2 years, and that will happen through a higher spot price. Will it happen tomorrow? Probably not. Will it happen over the next 6 months? Perhaps. And that's also the reason why we think from a sort of hedging perspective that it makes sense to hedge EUA exposure, and probably also hedge more than one benchmark would indicate. One thing we can do is to also to say what are the speculators doing. We actually have quite good data from what speculators are doing. We don't have speculative clients. We have corporate clients. This is from the ICE. When you trade on the ICE exchange, you have to tell why are you trading, because you have a client that are a speculative client, or because you have a client that have a hedging need. So what we look at, what are the speculators doing? In the first couple of months of the year, basically until the Rose Garden tariffs performance by Trump, the market was speculatively long. A lot of investors were buying emissions, positioning for higher prices, probably trying to front run this tighter market next year. Then came the drop in equities. Everything was concerned. People were stopped out. They took their stop loss. They sold their long positions. But it seems like they are starting to buy again. And I think they are buying into this case that the European economy may not be that weak, and that we will have a tighter market next year. And I think there are some sense in that. Short term, I would like to see prices dipping below 70, but I actually think that here the next couple of months it's a time where you should start considering sort of doing more long-term hedging, given the sort of supply and demand outlook for next year and the year after. If we just very briefly to talk about some of the other price drivers we have in the market, we talked about the maritime sector will be fully included, add positively. No more free allowances for the airline sector after this year. This linear reduction factor. Auction demand is something we look at almost every day. There's an auction. We look at how is demand there. There's a fixed amount. How many bids were there at the auction? They're sold at the EEX. Renewable use in the power sector, very important. We talked about the less wind during the last couple of months, but we certainly do expect a lot of solar power in the system. That is a bearish factor. The so-called CBAM sectors, cross-border adjustment mechanism, that is sectors like cement, aluminium, steel, electricity, fertilizers. They will start to have their free allowances phased out. Remember, a lot of industrial companies have free allowances they receive to be competitive. The CBAM indicate that you have to buy allowances if you import these goods like cement from outside the EU, but then you cannot also get free allowances in the EU. So there will be a phase out of allowances in these sectors, CBAM sectors, whereas the CBAM will be phased in over the next 6 years. There will be an EU ETS 2 starting in 2027. It's a separate system. It covers, among other things, heating in buildings and land transport, but it could have some spillover. Remember, it is a political market. We saw it with the Repower EU. Maybe we need a lot of funding also this year. Who knows? Then maybe someone come up with an idea. Maybe we can also borrow some more EUAs from the future. For those of you exposed to the UK allowances system, that will be relinked to the EU allowance system. That could also have an impact, mostly probably on UK allowances. And then, of course, speculative activity is important. It does create some volatility, and it can sort of intensify both moves, both higher and lower. But over time, this is a physical market. It is decided by supply and demand. Eventually, if you have an emission, you will have to hand over the allowances the year after. That was basically what I have brought with me today. And as I said, feel free to ask questions in the Q&A, and you can do it anonymously, and we will take the questions after Daniel's presentations. Over to you, Daniel.
Thank you very much, Arne, and good afternoon to you all joining in here on the webinar. So I have the pleasure of talking a bit about risk policy and how you can structure a hedging strategy. This will be like hedging strategies in general, and of course bear in mind that this is not like a one size fits all. It's very dependent on the type of company and business that you are in. But if we start from the top, speaking a bit about risk policy. So what is a risk policy? Risk policy is basically a document that you have agreed upon in your company on how you are exposed to risk and how you want to handle the risk inherent in your operations. So all else being equal, higher volatility brings on a higher need for risk policy. And as Arne has already shown earlier in his presentation, for example, the EUA market, as well as other commodity markets and energy markets in general, they are very volatile. So prices will have big swings going both up and down. And what about the risk policy? The risk policy should basically be a reflection of your company's risk aversion, so your attitude towards risk, and not like, let's say, your personal attitude towards risk, but the company's attitude towards this. And furthermore, it should also be supportive of your budgets. A part of this risk policy that you introduce might involve using a hedging strategy as well for various subcomponents of the universe that you are working in. It should also always take into account the volatility of the underlying products. Of course, higher volatility calls for a tighter or a more structured hedging strategy in general. And what can this hedging strategy help you with? Well, it can lock in cost structures. It can lock in your future budgets. It also acts quite a bit as an insurance for your company for prices going very much higher. And finally, it can also help you optimize liquidity. But in order to build a proper risk policy and hedging strategy, some of the things you need to look into and determine is, of course, how and when your company is exposed to these various factors. And that is both for the present, but also very much for the future. Then before looking into hedging strategies in general, I just want to introduce the concept of risk aversion. So basically, as already mentioned, your risk aversion is your company's tolerance towards risk. So that being said, it's a very important concept when you're speaking about energy risk management on a corporate level. And this is also not a one-size-fits-all across sectors and across companies. It varies a whole lot depending on the nature of your business. It will depend on your competitive situation, your pricing power, etc. A whole lot of variables are going into to this discussion. But one thing's for certain, that understanding your company's risk aversion is key when you're creating a strategy for managing future energy price exposures. But then let's go a bit more into to how you can structure a hedging strategy. And again, bear in mind that this is not a one-size-fits-all. This is like some general thoughts that you can take with you and that you can use as a starting point when you're looking into to developing a hedging strategy in your company. So all else equal, the higher the risk aversion you have in your company, and again, a high risk aversion means that you do not want to take on a whole lot of risk, whereas a low risk aversion means that you can deal with higher risk levels. So all else equal, a high risk aversion will also lead to a higher degree of hedging. And when we look at this, how does this reflect into, let's say, if we want to put some numbers on how much do you want to hedge on your future consumptions? Then, of course, if you have a company where the risk aversion is high, then first of all, you have a high degree of hedging. But secondly, you would also want to have a very tight band on how much you can go up and down in terms of hedging your positions. Whereas a company with a low risk aversion will have, in general, a lower degree of hedging, but they can have the possibility to go from a very low degree of hedging to a somewhat higher degree of hedging in order to take opportunities in the market when prices are very good. Then you can go to a very high level of hedging. And again, on the opposite, the high risk aversion companies, they don't want to have a lot of let's say wiggle room in terms of how much they hedge. They want a very tight band on the percentages. What about when we start introducing the concept of time to your hedging strategy? Then, of course, when we look in the very near future, we have a high degree of certainty on what's going to happen. So tomorrow, we have a very high certainty on the energy, for example, that we're going to use, whereas in 3 years' time, we might not have as much certainty. So in the short term, you want a high degree of hedging, and you will not want to introduce a very wide band on how much you can hedge. Whereas looking further into the future, you want in general a lower degree of hedging, but you also want to have the opportunities to go very high within the levels that you've approved. Again, for taking on possibilities that the markets will bring to you. And this is for a company, let's say, that is using hedging as an insurance. If you're a company, for example, that's project-based or based on contracts, then we would argue that the hedge or the degree of hedging should be very high, also looking into the futures. Because if you've made a contract or if you have made a project with a fixed price, then of course you want to have the security on the energy price exposures as well. Then let's look a bit into how you can actually do your hedging in these energy markets. So we have what we call, for example, the objective approach. That's where you stand, let's say, at time 0. You're looking into the future, and then you want to say, okay, fair enough. When Q1 is over, we want to be hedged at least 25%. Then you start rolling on positions, so you end up at the end of the quarter at 100% of what you want to be hedged. This is not saying that you want to hedge 100% of your exposures, but 100% of the level of the degree of hedging that you've decided on. And then also looking into the future, let's say again we're starting at time 0, then looking into year 2 already now, you want to start on adding some positions to your coverage, but you could take, for example, half of what you're doing in the coming year and then roll on further as you go down the road, ending up at being 50% hedged, maybe at the end of year 1, and then when year 2 starts, then you start hedging, increasing your hedging. And one of the reasons to do this is if, for example, some companies are going out hedging in October when they do their budgets for the coming year, they want complete certainty. But then, of course, you also add the risk of you hedging at the very highest price of the year. This is a way to avoid hedging at the one price that was perhaps the highest during the period. Then you could also add another variable to the picture as well. We call this combined approach. So you want to roll on your positions again, so you increase your degree of hedging when you move further on in the year. But in this example, then you also take into account the price of the underlying commodity or energy source. So, for example, here I have taken the EUA price historically. I've divided it into 2 quartiles, and in this way we can say, okay, fair enough. If from a historical perspective we see that the EUA price is very low, then we want to be in the high range of the degree of hedging. Whereas if we're in the high price area, then of course we still want to adhere to our risk policy, but we want to be in the lower range of what we have agreed on within the company. And in this way, you combine the 2 approaches, and then you could of course also add another level of some analytics and some consensus estimates on the pricing, and then you add much more layers to your strategy. And then finally, just a very brief, so what are the common financial tools that you can use for hedging these products? Let's say in the EUA market, you can either use forwards, you can also use call options. It could be that you, for example, in a business where you want to have a cap on the risk on the upside of prices, but the competitive nature of your business tells you that you also need to be able to go down on pricing if prices fall, because your competitors will be able to reduce their prices. Then an option strategy would, for example, be the best way to go about it, because this gives you the upside, what do you call it, security, whereas you still have the downside opportunity of buying lower. So that was actually what I had on the agenda today. I will leave the word again to Arne.
Thank you, Daniel. And remember, you can ask a question using the Q&A button, and then you can post them with your name or anonymously. And we have actually received some questions, so I think I will start from those that came in first. How's the liquidity in the EUA market? Maybe Daniel, you are active in the market. Maybe you can say a few words here.
Yeah, I can do that. So as the EUA market is a listed market, there is a high degree of liquidity in these markets, and liquidity meaning that it's cheap to trade, and there's not a big bid-offer spread between where you buy and where you sell. So basically, in general, these are very liquid and very transparent markets.
I think there's a bit of follow-up question here. Is it correct that the EUAs are traded in lots of 1,000 metric ton, and that delivery primarily takes place in December? Yes, it is correct that the ICE future is the most liquid, is the December contract. There's also a April and September contract, but we actually offer a sort of liquidity across the curve. You can come to us and we can do any OTC, any forward, any swap on any date, basically any size, in theory, down to 1 metric ton. And given that the forward curve is decided by the interest rate curve, it's relatively easy to put a price on any delivery date. We're not sort of bound to the futures market. Remember, the futures market was initially set up for the power sector that have a huge turnover. Then there's a question, I think that will be for me. What impact do you think the 2040 EU climate target announcement will have on the market? As far as I understand, that will be on July 2nd. It was, as far as I remember, delayed from March. And as the listeners write, an expectation that emission will need to be cut by 90% by 2040. And there's uncertainty as the role that international carbon credit could play. Of course, if there's actually a 90% reduction target by 2040, it will put a lot of pressure on the EU ETS. You will need to take out even more allowances to reach that target. That could really push up prices. That, of course, has given rise to a lot of concern. So what I understand is that the EU Commission are considering allowing use of carbon credits. That is basically investing in programs that reduce emission, often outside the EU. The classic one is, of course, keeping some rainforest in the Amazonas to save or to absorb emission, investing in CTS and so on. I think it underlines that the EUA market, the EU ETS, is a political system. We have to be aware of that. That creates uncertainty along the in the market. We saw it with the Repower EU announcement, where you borrowed from the future. This is another one. If we see the headline that they are now allowing carbon credits from the non-regulated markets, it will, of course, it could have a negative impact. But on the other hand, if you lower the target to 90% by 2040, it is quite ambitious. So keep an eye on what comes out. It might be out, in over the next month. But key will be this about allowing carbon credits. If they don't allow carbon credit, this could be quite bullish for the market. If they allow, which I think they will, it should be more neutral. I don't think they're coming up with something that will actually weaken the EU ETS system. But that said, we are in a very special situation in Europe. The German manufacturing sector is struggling. There is probably a political pressure to ease cost for the manufacturing sector. Remember, gas prices are just 25% in northern US compared to Europe. So there's this pressure. Can we lower cost somehow? And of course, it's obvious to also look at the EU ETS. Underlines it is a political system. I hope, Peter, that answered your question. But it creates uncertainty here over the next month. Then there is a question. I think that would be for you, Daniel. If you have a so-called basis risk in your hedge, and the writer asks, let's say that you use the TTF in gas for hedging a Polish gas price, what will be the impact of your hedge ratio?
Yeah, so in general, the basis risk when you do commodity hedging is the risk that the benchmark you are hedging on is not completely the same as the index you're buying on. So the risk between the two going apart from each other, and of course, all else equal, this is not again it's not a one size fits all answer, but in general we would say that you would need to have a lower hedge ratio if there's a lot of basis risk in your from your index that you're buying on to the benchmark that you are using for hedging. So, for example, let's use the TTF case that the listener here is referring to. So, if you, for example, are a Dutch production company buying natural gas on the TTF and you're hedging on TTF, then you have one-to-one coverage on the product. Whereas, of course, in this case, if you have a Polish gas consumer hedging on TTF, there will be some differences between the two indices.
And that would normally speak in favor of a lower hedge ratio, right?
Exactly, yeah.
Could you elaborate a little on how expiry dates on options impact the market? Yesterday, for example, we have seen a surge to almost 75 euros due to positioning covering for options with a 75 strike price. I don't know, Daniel, if you would take that one, or should I take that?
You are welcome to do so.
Yeah. We have this overview of what options have been written in the market, if they're listed, and of course, if you have written an option, you might have the obligation to either have to deliver or buy at a certain price. So that gives rise to a risk for those. Normally, it could be a bank or a company like our own who have written this option, and to cover that risk, normally the trader will have to go into the market buying the underlying asset or selling the underlying asset, depending on what the option is, and that can of course create some extra buying in the market related to this. And sometimes, of course, if the market sort of smells that there are someone out there that have to buy at any price, it has tendency to sort of exaggerate these moves. So option expiry can have an impact on the market from time to time. And I think it also underlines that you have like a risk on a single day. It is something to be aware of. They can be intraday volatile, the EUA price, even though we would normally say the liquidity is quite good. I don't know if you have anything to add there, Daniel.
No, I would just add that it's of course when you have an option that's in the money, that as Arne said, that you have sold, for example, then of course the delta that the hedger or the trader needs to buy will increase. So he will need to buy much more of the underlying because he is going to be obliged to deliver on what he's sold. So for example, if you have a lot of written options on EUAs, let's say on 70 or 72, 72 and a half, then as we approach expiry and the price is higher than the level they have written options at, then of course they will start buying the EUAs to cover their short position.
I hope that answered the question. I don't think we have any. Oh, there's some more questions here. Sorry. Will the EU ETS 2 in 2027, as the new system, also be linked to the current EUA market pricing? No, I wouldn't say that. That is a standalone mechanism. That will be a specific market for EUA 2s. You cannot buy them as a paper, as a physical, as a certificate as of today. There is a future on the ice. I can't remember. It's December 27 or 28. I think it's 27, but it's very illiquid. But in theory, they are delinked, these two products, but they will probably tend to trade in tandem. But it's not like you can buy an EUA 2 and hand it in, surrender it instead of an EUA 1. A very good question, but it's something to, of course, keep an eye on. The EU ETS 2, as I said, covers land transport, combustion in buildings, and it will be the supplier who are responsible for that. Whereas in the EU ETS 1, the current system, it is the emitter that are responsible. I think that was, we got through all the questions as far as I can see. I think we will call it for today. Please feel free to reach out if you want to know more about what we do at Global Risk Management. If you have any questions to me or to Daniel, yeah, feel free to reach out. And then you're more than welcome to sign up for the research I do. There is this QR code on the screen. Thank you all for taking the time to listen to us. Have a good day. Bye-bye.